Hi, everybody. Hey, this week we're going over why interest rate in the US is still very high and what is it relative to the world? Do we have enough reasons to lower rates? And what if we don't? What kind of companies are most at risk if interest rates stays this high?
Yeah, and if this is Emile, our stock of the week this week is Pfizer. It's down 21% this year and over 60% from its COVID peak, with shares trading at $23 per share compared to their IVoT Forecaster cash flow value of $100. It's a good time to take a closer fundamental look at Pfizer.
Welcome to IVoT Ion Investing, a discussion of the markets and investing from a long-term fundamental perspective, hosted weekly by IVoT Academy. I'm your host, Ed Butowsky. We are joined today with two esteemed IVoT experts, market analyst Andrew Tang and equity analyst Emile Westergaard. This week, Andrew will take a look at the risk that the Fed decides not to lower rates and who it might impact. And Emile is going to analyze Pfizer using the powerful IVoT Forecaster tool. I want to point out that what Emile does is he looks at the fundamentals of a company. He doesn't look at the growth projections of that company. I think it's important when Emile goes through his analysis for him to point that out. But welcome, viewers. And before we get started, how was your week, Andrew and Emile?
Pretty good. I just came back from a pretty long trip from Florida. Was in Pensacola and Jacksonville. Very nice weather. Rains a lot, of course. That's Florida. And I'm back at the saddle.
Well, good. Well, welcome back.
Yeah, and we're at the last stages in the IVOT of getting ready to launch the platform. So for those of you who are watching, it's very exciting to see the progress we're making and actually going to be showing it to you, Ed and Andrew, this week. So exciting to give you guys the keys to the newly minted car.
Well, we're excited about it. And the purpose of this show is to gain attention for the IVoT Academy, which the IVoT Forecaster is a main part of. So I encourage everybody to dig in and look for the IVoT Academy. So, Andrew, why don't you kick us off with your thoughts on the Fed Reserve under Powell?
Yeah, current interest rate in the US is still 4.25 to 4.5 in that window. That's the Fed funds rate. And what that translates to, it's still very high mortgage rates, and it is not sitting well with many companies that have loans out there, right? So relative to the world, what is US interest rates and how are the metrics compared to the rest of the world? So I have this chart number one to show
Yeah, and if
you,
you can give me share, I'm going to pop up that chart for Andrew here.
or
There you
I,
go.
yeah, okay, restart. So I'm going to go over for the audience to look at where US interest rate is. So looking at this chart, courtesy of tradingeconomics.com, you'll see that the very top line is United States. It's ranked by the size of the GDP, so the size of their economy, and you can see that we're at 4.5%, right? And then compared to UK, why did I highlight UK? Well, because Bank of England is about to lower interest rates, and you see that under the inflation column, UK, it's very obvious they have 3.5% inflation, while we are at 2.3. So regardless of what tariffs is going to bring in terms of price adjustments in the short term, we are very similar in the jobless rate data, meaning unemployment data. But you can see that Europe and many other countries in the top 10 economies, they're much more willing to lower interest rates to help stimulate growth. Obviously, India is a separate issue because, you have very high unemployment rate and you do have higher inflation. So they have to take their time to do that. But relatively speaking, we wanted just to highlight where we are compared to other countries. So with those metrics, I want to go to chart number two, is that we're still, meaning the market, it is still pricing in for two Fed cuts for 2025 for the rest of the year. Now we do have 5 upcoming meetings, and most likely the June meeting we're not going to have any Fed cut, and that's over 97% according to Polymarket that the probability of the June we're not going to get a rate cut. But we still have 4 more meetings coming up, and that's very positive. And the market is pricing in at least 2 to 3 rate cuts. So we will see what happens. Now, what's going to happen if we don't get a rate cut? Now, I would like to, show you another chart, which is the third chart. Now, this is a chart of the 30-year jumbo mortgage, fixed rate jumbo mortgage rate. And right now we're sitting at, 6.95% right now, right? And that's for household. How is that relative to commercial or businesses, right? So I take commercial real estate companies, for example. That's one of the top sectors that is going to be in danger if rate stays this high, right? And if you look at what kind of borrowing costs that they're facing, like for example, for a commercial real estate developer, from banks and credit unions, these are the lower cost tier of borrowing. They run from anywhere from 5 to, let's say, 7.5%. Then you have these commercial mortgage-backed security loans that can run from anywhere, let's say, 5.5 to 8%. You see how it goes up. Then you have these government programs that can go up to about 7 to 8% as well. And then you have these bridge loan category that runs anywhere from 8 to 12%. There's really rarely any bridge loan that goes less than 8%. And then you have the highest tier, which is what's called a hard money loan, and that runs from 10 to 15%. Okay. So you can see that in aggregate, for a commercial real estate operator or developer, you're facing cost of capital anywhere from 5.5 to 15%. So the chances of you surviving it, this is absolutely not sustainable. And on top of all that, businesses, including that particular high risk sector, they have many outstanding loans. There is over $1 trillion in loans that needs to roll over, which I've mentioned, in the previous shows. And that is a huge problem. So that's the first tier or the sector of companies that are most at risk. Now, the second tier would be highly leveraged companies. For example, companies that have a huge loan amount on their balance sheets. And in the private market, there's something called CLOs. These are the collateral loan obligations. And many of these instruments, they don't trade publicly. So, I would say beware because a lot of companies that issues these CLOs, they could be at risk. And again, you're not going to see a lot of that in the public markets. Most of these are hidden in the private space. So, that particular sector could be forming a bubble or being overvalued. Last but not least, the third tier. Now, these are cyclical companies that are consumer facing. So it could be retailers, restaurants, and again, these companies indirectly related to consumer confidence and as well as high cost of capital. They really act like a tax on consumers. So the higher the cost of capital, just like you have to pay higher or more for gasoline, you're just going to spend less. So I understand the dual mandate with the Federal Reserve to make sure that inflation is controlled, 2%. And again, we're very, very close, 2.3%. If you look at Trueflation's new method of collecting inflation data, we're at 1.9, 1.9%. So, and according to experts, the tariffs will cause short-term price adjustments, but over the long term, we don't believe that inflation will be a long-term effect for tariffs to kick in. Obviously, there will be transitions, but again, I like to highlight the 3 areas that are most at risk if inflation or if interest rates stay this high. So I really urge the Fed to restart lowering rates by at least 25 basis points so we can get the growth or the continue of growth started.
Andrew, I listen to a lot of strategists, but you're very concise, very direct. You speak exactly to what I think most of our listeners want to hear, and I appreciate it. Emile, you're up. What does the IVoT forecaster have to tell us about Pfizer?
Sure. Let's just go directly to the tool. This is, by the way, the IVoT platform, which we're familiar with and which will be opening up in the next couple of weeks for the public. Very exciting. And for clients of people who want to offer this to their employees, customers, whatever. So it's kind of IVoT inside, as we call it. Anyway, yeah. So as Ed noted, this is the IVoT Forecaster for Pfizer. This is one of the things you get access to on our platform. We have company tools and can create company tools for any public company. This tool is, as you can see, based on Pfizer's results for the first quarter of 2025. It says it right here. And you can see that right now the stock is trading at $24. Now, I don't have the stock chart up here, but basically the stock peaked at $60 during COVID because they had the leading vaccine and treatment for COVID. So they were pulling in money hand over fist, but that was short term. And that's one of the challenges, by the way, of valuing and investing in pharmaceutical companies, because their products can have significant volatility in sales and ultimately in the company's cash flow. So that was a big boon for Pfizer for about 2 years and then rapidly went away, and the stock price reflected that. Now, as a long-term investor, we want to know what is the long-term cash flow profile of the company. So if we say, well, this one-time event around COVID went away and we're sitting now more at a long-term view of Pfizer, well, the quarterly cash flow right now is about $6 billion. And you can see it was flat from a year ago. And that would equate, according to the IVoT method, to a cash flow value for the company of $100 a share. So, you know, it's classic, really, when a company's cash flow goes down, that the market kind of throws out the baby with the bathwater, you might say. And in this case, it looks like the shares have way overcorrected, given the actual fundamental value of the company. Now, there is, of course, the risk involved in their other drugs, because basically what happens with a big pharma company like Pfizer is they sit on big drugs that are their core. And in this case, their top 5 drugs are about 50% of their revenues. And eventually those drugs come off patent. So it's up to Pfizer to replace those cash flow streams. They had a lot of cash during COVID to buy products for their pipeline. So it's going to be interesting to see what comes out of that spend that they made over the last couple of years with that extra cash flow in their pipeline. And that's something you can come to our platform and we'll help you analyze. Analyze the current pipeline, when does it fall off, and what are the future cash flow streams that are going to be coming into Pfizer. But net, buying a company for, you know, $24 that has a current cash flow value of $100 looks pretty interesting, and one that I would, you know, think about taking a look at. And again, I was a professional healthcare investor on Wall Street specifically. So this is really my most comfortable neck of the woods as an equity analyst. The other thing I'll just say, and I know that Ed actually was the one I think who suggested we take a look at Pfizer. And I know Ed's also interested in dividends. And in this case, right now, Pfizer has a whopping 7% dividend yield, which is pretty, pretty interesting for people looking for a dividend stream from their equities that they own. So I'll leave it at that, and maybe we can discuss both Andrew and my commentary as a group now for a couple of minutes. I'll stop the share.
Yeah, so Emile, on the healthcare side, do you see that specific to Pfizer or other healthcare stocks?
Well, no, I think, it's pretty much unique to every company, right? Lilly has been a freaking rocket ship with their, diabetes weight loss franchise. So it really depends. And again, Pfizer was a rocket ship for 2 years because of COVID. It's just diabetes is not going anywhere. COVID went somewhere. So I would say Lilly's on a little bit more solid footing in terms of thinking of it on a long-term basis. So no, I think, I guess what I would say at IVoT is the market goes up and down. The market's opinions and sentiment on companies and the market itself goes up and down. The real investor, from our perspective, knows what things are worth and takes advantage of the kind of Mr. Market, as Ben Graham famously put it, the schizophrenic market that's going up and down all the time. And you want to know what you want to buy and take opportunities when the market's being, again, mispricing things on the up or downside for that matter.
So can you identify fundamental analysis versus technical analysis? Because the IVoT Forecaster is truly a fundamental analysis tool.
Yeah, I mean, technical analysis is a tool for traders who are trading the market day to day and want to know what the current movements in the stock imply for near-term movement in the stock. That's for the most part. I mean, you can also do longer-term technical analysis, and we do some of that at IVoT, but for the most part, at IVoT, we're trying to be outside of the market, treating ourselves as shareholders and owners of a company in a classic fundamental sense. We buy, we're not daters, we're marriers, as you might call it, right? We don't want to just sit here and get in and out of stocks all the time. We want to find good long-term positions that we literally put in the closet and we own forever. And if we decided a stock's worth 100 and it's trading at 24, we keep buying it. And then as the market decides, hopefully agrees with us and the stock goes up, we might decide at some point to stop buying it. But ultimately, we're looking to buy stuff on the cheap. And that's fundamental investing. It's pretty straightforward.
Yeah, I think I'll add a little bit here is that with IVoT, you have the tools to get all the data that you need to make your case. And with the technical spin on this, Ed and Emile, is that I look at the chart and I see that the stock has retraced all the way back down to the levels back to 2012. So a very simple question to ask, is the company right now in a better shape than in 2012? And this is all pre-COVID, remember, okay? So the answer to that is yes, right? If you look at all the data in terms of revenue, in terms of operating profits, balance sheets, so on and so forth, the company is in better shape now than in 2012. You got a good, healthy, pipeline going, and as well as the coverage of the dividend is actually in a good place. So simply put, when a stock retraces down to these levels, it's really at bargain basement prices. But there's a political spin in here as well, because drug companies are forced and pressure to lower costs of drugs. Otherwise, the government or they threaten to do it forcefully, and that's why it is scaring Mr. Market.
Yeah, and I want to say, first of all, let me say that's we're giving opinions here. That's Andrew's opinion.
Absolutely.
What you do have
Not
at
investment
IVoT,
advice.
what you have at IVoT is the training and the tools to create your own view. I mean, that's really what we want you to do. So we'll show you how to look at the balance sheet of all the topics that Andrew's saying, and to do your own fundamental analysis and decide what you think it's worth. There is always risk to views, right? And as Andrew's pointing out, pharma, because it's a globally paid for predominantly by governments and through regulated pricing, is always at risk of pricing issues and different things going on through the governments. That's why you want, in a sense, a good risk reward ratio with a pharma company. If I think the company's worth 30 and it's trading at 25, it's not interesting.
But it has a forward PE of 8, which is relatively low.
Yeah, again, we don't use PE at IVoT, but we do. I don't want to be clear because you said this at the beginning of the show. We do forecast future cash flow. Absolutely. What I want you to do at IVoT is come look at Pfizer if that's what you're interested in. And what you have to do is look at the top 5 drugs that are about 50% of their sales and say, well, how long do they last? When are they going off patent? And what do they have to replace those cash flow streams over the next 5 years in the pipeline? And how risky are those, right? Because there's no guarantee that a new drug is going to work and that it's going to get through the pipeline. But as a professional healthcare investor, I can, and we will maybe do some, not even maybe, I know we're going to do some more detailed company shows where I can show you how to assess the risk of those pipeline assets, because that's key. You want to know How big is that market for that drug? What is the differentiating technology they have? What is the competition, et cetera? Those are all fascinating work to do that I've trained many people on Wall Street to do, actually. And so that's a benefit of kind of coming to the deeper end of our pool. And again, we start out simpler. We start out training you the techniques, and then you can go as deep into our pool as you want.
So to kind of summarize for Andrew and Emile, this show is really a catalyst for you to learn about IVoT Academy. And I really encourage everybody to sign on to the link that's below and look into IVoT Academy. It'll make you a smarter investor, and it'll allow you to hold your financial advisor's feet to the fire. When they say something, you're able to kind of check it out and see if it makes sense or not. But so Emile and Andrew, thank you very, very much for joining us today.
Thank you for having me.
Thanks, Ed.